Hello, let's get started with the Chapter 3 homework assignment. So we're looking at the adjusting entries. Let's start with a quick review. So this is the summary sheet that I used at the end of the lecture. We have three different kinds of adjusting entries, right? We've got the accruals. We need to accrue the revenue. This is what we're going to do, right? Record a receivable and record the revenue. We need to accrue an expense. We'll record the expense and we'll record the wages payable. We need to record a deferral. Well, if we have a deferral, then that means that we have to adjust that revenue because we've earned it. So we reduce the liability, we increase the revenue. If we need to adjust a prepaid expense, well, then what we have to do is recognize the expense and reduce the asset. And then the third kind of an adjusting entry, the depreciation, debit depreciation expense, credit accumulated depreciation. And we'll refer back to this if we need to as we go through the homework assignment. So let's see. The first one on the list is BE 3-4, an adjustment for an accrued expense. So we have an accrued expense that we're going to be adjusting for. If it's an expense that needs to be adjusted for, well, then we know, again, let's go back here, an accrued expense. We're going to be debiting some kind of an expense and crediting the liability account. That's what we need to do for an accrued expense. So in this case, we've got some salaries. So what we know is that the weekly salaries for a 6-day work week are $34,500. And now we get to the end of the period, and the period ends on Friday. So normally, let me see if I could write this out here. So let's see, a 6-day work week. So six, 6-day work week, right? Which is Monday through Saturday, right? 6 days. And what it costs for a 6-day work week is $34,500. $34,500. So that would mean that if it's $34,500 and it's for 6 days, right? Then what it costs for one day, 34,500 divided by 6 is a 5,750 per day. That's what we know. And it's time to adjust the accounts because the work week, um, the work day of this work week is Friday. That's when the accounting period ends. So actually what we have, right? We've got to accrue an expense. We need to accrue an expense for Monday through Friday, right? Which is not 6 days, but 5 days, right? We need 5 days, Monday through Friday. And since we're accruing for 5 days and we know that it is 5,750 per day, then that means that we've got to accrue this expense for 28,750. That's our accrued expense. So again, to accrue an expense, we're going to, now we don't have a date here, but I want to emphasize here that this is on Friday. On Friday, we're recognizing this expense, right? This expense for the 28,750. And we also have to recognize the liability, the obligation. 28,750. So again, what are we doing? We are recognizing that the accounting period ends on Friday. Friday, Monday through Friday is only 5 days. Their normal work week is Monday through Saturday. So normally they don't recognize the expense related to the work week until Saturday. But this accounting period ends on Friday, a day before Saturday. We've got to recognize that we've accrued an expense, right? We are obligated now to pay this expense for 5 days, Monday through Friday, 5 days, 57.50 a day, 28,750 is our accrued expense. That's our adjustment to bring two accounts up to date. We've got to recognize the expense So we bring the expense up to date. And we've got to recognize the liability. So we bring salary payable up to date. That's BE 3-4. Next. BE 3-5. Now we've got an unearned revenue that we need to adjust for. So very quickly, unearned revenue, what does that mean? That means that initially the revenue was received in cash, but not earned, so it went into an unearned account. Now when we adjust, we take it out of the unearned account and we put it in the revenue account. That's what we need to be able to do here. We need to recognize that they received this rent, right? They received rent of $9,000 for 12 months. So they received rent of 9,000 for 12 months, right? 9,000 for 12 months was received. And that was received on June 1. Received rent of 9,000 for 12 months. So they received rent. Let me just make a note here. Received rent on, that's not what I want to do. On June 1. They received this rent on June 1 of $9,000 for 12 months. And how much is that? So if we take that $9,000, right, and divide that by 12, we get the monthly rate of that rent. So the rent is $750 per month, right? So initially, they would have put this $9,000 in an unearned revenue account. And now it's 7 months down the road, right? So June 1 through December 31 equals 7 months. We need to adjust the accounts for those 7 months because the unearned revenue account has 12 months of rent in it, but 7 months has now elapsed, and we need to recognize that revenue for 7 months. 7 months times 750 is $5,250. So what we're going to do on December 31st is we're going to recognize now that we have to reduce that unearned revenue account. The way you reduce a liability account is to debit it. We're going to debit it for 5250. And we're going to recognize the revenue. So this is the rent revenue, right? We've got rent revenue of 5250. And that's our adjusting entry for unearned revenue. So again, initially it was deferred. Now we are recognizing that revenue. Okay, next one. Now we have an adjustment for a prepaid expense. So prepaid expense. So another one of those deferred items. Prepaid expenses are a deferral. So initially, the payment for the insurance or any other prepaid item goes into the prepaid account. At the end of the appropriate period, we've got to recognize the expense and reduce the prepaid account. So that's what we have here in exercise BE 3-6. It's a prepaid expense. They paid their insurance in advance. So if I could, I think sometimes it's helpful here if I can kind of talk through this in terms of a kind of a T account, right? So if we think about this, right, we've got here, and let me switch back to typewriter mode. We've got prepaid insurance. We've got prepaid insurance. And what's happening is this prepaid insurance account had a beginning balance of $6,000. A beginning balance of $6,000. So think about this here. BB for kind of a beginning balance, or I'll just say B balance, beginning balance. We've got a beginning balance here of $6,000. That's what we started out in this T account with. And what happened during the year was they debited it for another $12,500. So they added another $12,500 into this account. And essentially what that means, right? If I could, let's see here. Um, the total, right? If you add these together, the total is $18,500. So what we're saying is we've got an account now, that a prepaid insurance account that has a total of $8,500 in it, right? That's the sum of those two. But what's happening is we get to the end of the period and they tell us that an adjusting entry is required because the amount of unexpired insurance that relates to future periods is only $13,000. What does that mean? Well, what that means is the prepaid insurance account should only have $13,000 in it because that's the amount that's unexpired. This account has 18,500 in it, but what it should have, and I'll call this the ending balance, what this account should have is a balance of $13,000 in it. That's what it should have. So it's got 18,500, but it should have 13,000 in. We need an adjustment, right? We need to be able to adjust this account. We need an entry over here that will reduce this account from 18,500 to 13,000, right? So essentially what we're saying is 18,500 minus the 13,000 gives us the amount of our adjustment. We need a $5,500 adjustment. That's our adjustment, right? Because we need to take this account from 18,500 to 13,000. The difference between 18,500 and 13,000 is a $5,500 adjustment. That's how we get from 18,500 to 13,000. So the basic adjusting entry that we need to make here at the end of the year, right? The end of the year, right? End of year. The end of year adjustment here is to debit insurance expense for the 5,500 and to credit that prepaid insurance account for the 5,500. And now that's our adjustment because now what'll happen is that credit of 5,500 brings this account now down to $13,000. And that is an adjustment for a prepaid expense. Okay, next. Depreciation. Now, the thing I like about depreciation is that it is the easiest adjusting entry, right? Every depreciation adjusting entry pretty much looks the same, right? We're going to debit depreciation expense. In this case, it's for 33,200. And we're going to credit that contra asset account we call accumulated depreciation for 33,200. And that's the entry for the depreciation, that third kind of adjusting entry. Next, let's look at accrued fees. So now we have an accrual. We need to accrue for these fees, accrue the fees. So at the end of the current year, they've got $17,950 of fees that have been earned, but they haven't billed yet to the clients. So again, as a review, an adjusting entry for accrued revenue. That's one of the first things we looked at. An adjusting entry for accrued revenue. We need a receivable, debit that, and a revenue to credit it. That's all we're doing with an adjusting entry for accrued fees. So if we've got fees of $17,950 that we've earned, but we haven't billed for yet, then again, we need a receivable for $17,950. And we need a credit to the revenue account, fees earned, for 17,950. And that's the adjusting entry to record the accrued fees. I got a question here. What if they'd been using the cash basis? If the cash basis rather than the accrual basis had been used, would an adjusting entry have been necessary? Of course not, because when we use the cash basis of accounting, we only record transactions when there's cash involved. There's no cash involved here, right? They're billing the customer, but they don't have the cash. So if there's no cash involved, then under the cash basis, there's no transaction required. We wouldn't debit anything or credit anything because we wouldn't have any cash. So the only time we're going to make this kind of an entry is when we're using accrual basis accounting, right? We've got to apply the revenue recognition principle. We've earned the revenue, even though we haven't received it, we've earned it. So we have to debit accounts receivable and credit fees earned. Next, we need another adjusting entry for accrued salaries. An adjusting entry for accrued salaries. So we've got a work week. In this case, the work week is Monday through Friday. So Monday through Friday. 5-day work week, Monday through Friday, cost them $18,500. So that Monday through Friday, $18,500 divided by 5 days. It's a 5-day work week, right? Divide by 5 days means that we're looking at $3,700 per day. And now we get to the end of the accounting period and it ends on a Monday. So we need an adjusting entry for one day, right? In A, we have Monday, which is one day. So we need an adjusting entry for Monday only for one day and an adjusting entry for an accrued expense. We're going to be debiting some kind of an expense, right? And the expense is salaries expense for $3,700. And we need a liability to go with that, salaries payable, $3,700. That's it. One day, salaries expense, salaries payable. But let's change the assumption. Let's assume that it's not Monday. In part B, it's Thursday. Now, part B is Thursday. Part B is Monday through Thursday, which is in fact 4 days, right? So now we need 4 days. And what does it cost per day? $3,700 per day. So now we're talking about 14,800. We need an adjusting entry for Monday through Thursday, which is 4 days at $3,700 a day, $14,800. So now we're going to do the same thing we did in part A. It's the same basic transaction. We're going to debit salaries expense for 14,800. And we're going to credit salaries payable for 14,800. So the entry kind of looks like what we did in A, only the numbers are different, right? A is for one day, 3,700. B is for 4 days, 3,700 times 4. But the underlying transaction is the same. We want to recognize an expense by debiting salaries expense and recognize that liability. An accrued expense means we have an obligation to pay something in the future. So we recognize the expense, debit the expense, and we recognize our obligation, the liability, in this case, salaries payable. Next, back to unearned fees. Now we've got a situation where we've got some fees in this unearned fees account, that liability account. And the unearned fees in the account before we make any adjustments are 18,000. So again, let me try and I think it might be helpful if we try and think in terms of a T account here. So if I could draw a little T account here for what we're going to call unearned revenue. So unearned revenue is liability. Unearned revenue is a liability. So this is the unearned revenue account. And this liability account that we call unearned revenue, before we make any adjustments at the end of the year, has a balance of $18,000. Unearned revenue is a liability. Liability accounts normally have a credit balance. So this account has an $18,000 balance. And remember, this is before, right? It is before adjustment. And the adjusting entry. So we need an adjusting entry because the amount of the unearned fees at the end of the year is only $3,600. The amount of the unearned fees at the end of the year is only $3,600. So we're being told that the amount at the end of year is only $3,600. So we've got to adjust for the difference between what's in the account at the beginning of the period before adjustment and what we're told is in the account or should be in the account at the end of the year. So that means over here we need an adjustment, right? We need some kind of an adjustment that will reduce this account down from 18,000 to 3,600. So essentially what we need here, and I'll just make a note here, we need 18,000 minus 3,600, which is 14,400. That's the amount of our adjustment, right? We're going to need an adjustment over here for $14,400. That's the only way we're going to get from 18,000 to 3,600. So the adjusting entry for unearned revenue, we need to reduce the liability. That's why we're debiting it, right? That's how you reduce the liability. And we've got to credit that revenue account. So our adjusting entry here, unearned revenue, or $14,400. And we recognize the revenue, fees earned, $14,400. So again, unearned revenue, we've got to adjust that account and it has 18,000 in it. Before we make any adjustments, we're told that the amount at the end of the year should only be $3,600. So we've got to adjust for the difference. 18,000 minus 3,600 is that $14,400. Okay. Next. Now let's look at supplies. This is one we haven't seen yet. So we've got a supplies account, and again, I think it might be helpful if we try to think through this this deferred expense account. That's what this is. So prepaid, insurance is an example that we've seen before. Now we're seeing something that is a slightly different account, and that account is called, in this case, supplies. We've got a supplies account, and the supplies account is an asset, of course. And in the supplies account, what we know is before we make any adjustments, supplies is an asset. Assets normally have debit balances. Before we make any adjustments, this account, so before adjustment, this account has a balance of 5,175. And then we get to the end of the year and we're told that the amount of supplies on hand is only 615. So at the end of the period, this account only has a balance of 615. That's all that's on hand. That means over here we need an adjustment. We need an adjustment to get from 5,175 down to 615. 5,175 minus 615 means our adjustment needs to be 4,560. When we credit this account for 4,560, it will get us down to where we need to be. It will update the account, bring the account up to date. So we've got to make sure we are reducing the supplies account and recognizing the appropriate expense, right? It's an adjusting entry for supplies. So it's like prepaid insurance, like a prior example for prepaid insurance. So we need an expense, supplies expense for 4560. And we reduce that asset called supplies by 4560. And that's our adjusting entry. That's how we bring the supplies account up to date. We adjust it for those supplies that we've used. That's essentially what that 4560 represents. It represents supplies that we have used. And so we recognize them as an expense. Okay. Next, prepaid insurance. So on the same line as supplies, it's a deferred expense, right? We record it as an asset, and then we come back and in an adjustment, we recognize what we've used or what has expired. So in part A, we've got this insurance account. The insurance is paid in advance. And what they tell us is that they get to the end of the year and the amount that's expired, the amount of insurance expired is $18,000. That's the amount of the expired insurance. So there's nothing for us to calculate. They just give us the number we need for our adjusting entry, right? They're just telling us, well, the insurance expense is $18,000. That's the amount of expired insurance. And we reduce that asset account called prepaid insurance now by the same amount, $18,000. So that's a pretty easy one. They just give us the amount of the adjusting entry. And then what they do is they turn it around on us. And in part B, they state it a little bit differently. So now in part B, what they tell us is something a little bit different. And what they say is the amount that's applicable to future periods is 4,500. So what does that mean? What does it mean? Well, we've got an prepaid insurance account that has a balance before adjustment of 22.5. We get to the end of the year and the amount that should be in the account is 4,500. So we have to think about that just a little bit differently. So if we do it this way, so again, think about this T account called prepaid insurance, right? So if it's prepaid insurance, we have before adjustment a balance in this account. Before adjusting the account, the balance is 22,500. So we have a balance of 22,500 before we do anything. But we get to the end of the year, and in part B, it says, well, the balance that's applicable to future periods is only 4,500. So that means the balance in this account should only be 4,500, which means we need an adjustment, right? We need an adjustment to get it from 22.5 to 4,500. And of course, 22.5 minus equals 18,000. So we need an adjustment here for 18,000 in order to bring this account balance down from 22,500 to 4,500. So our adjusting entry, insurance expense, 18,000. And prepaid insurance, 18,000. And this entry is identical to the one we did in part A. So what's the difference in A and B? It's just how the information is given to us. In part A, They just tell us that the expired insurance is 18,000. In Part B, they don't tell us the expired insurance. Instead, they tell us what the balance should be in the account. They give us the beginning balance or the balance before adjustment. They tell us what the ending balance should be. We have to figure out what the adjustment should be, the 18,000. The entries are identical because it's the same problem. It's just stated differently in A than it is in B, but basically the same problem. Okay? Now, let's take another look at insurance, exercise 315. So to reemphasize that, again, we've got a prepaid insurance account that has a balance at the beginning of the year of $3,000. And what we know in this case is that the account was debited for another 32,500. So let me see if I can try to kind of summarize all of this in one T account so that we have everything in front of us that we need. So we have this insurance account, this prepaid insurance account. And in this account, we have kind of a beginning balance. That's what we're given. We're told that it's got a balance of $3,000. And then what happens is they add in or they debited in another $32,500. They added in another $32,500 into this account. And we need to consider in Part A that the unexpired insurance that is applicable to future periods or the ending balance in this account, the insurance that's applicable to future periods is only 4,800. That's what we need in that account. So let's see if I can make some notes here. This account technically has a balance of 35,500, right? That's what we have here. 35,500. That's what we've got in that account. After we started 3,000 and then we debited another 32,500, we've got 35,500 in the account, but we need a balance of 4,800. So we need an adjustment. We need an adjustment to go from 35,500 to 4,800, right? 35,500 minus 4,800. The adjustment needs to be 30,700, right? When we adjust this account now for 30,700, we go from 35,500 to 4,800. So our adjusting entry, again, same thing we did in the last exercise, right? Debit insurance expense for 30,700. And we credit prepaid insurance for 30,700. Okay. So it's kind of like what we did in the last exercise. We're just recognizing the amount of insurance that expired during the period. And we had to determine that. They didn't just give it to us in Part A. We had to determine that given what we started with in the account, what we added into the account, in order to get from that 35,500 to the balance that applies to future periods, the 4,800, is to adjust it by the 30,700. And that's kind of different from what they tell us in Part B. In Part B, they make it easy. They just say, oh, the expired insurance is 30,700. Well, if the expired insurance, the amount of expired insurance is 30,700, then we just debit insurance expense for 30,700. And we credit prepaid insurance for 30,700. So what I really suggest you do here is make sure you understand A and B because it's the same problem. A we have to figure out the amount of the adjusting entry, right? They give us the beginning balance, they give us the debit, and they tell us what the balance needs to be. And we determine that the amount of the adjustment needs to be 30,700. Whereas in part B, they just give us the 30,700. They just tell us the amount of the expired insurance, as opposed to us having to try to figure out what the amount of the expired insurance is in part A. Okay. Next. Let's move now to unearned and accrued fees. So we're going to do both in exercise 316. We have unearned and accrued fees. Unearned and accrued fees. So in part A, we're told that before they make any adjustments, this unearned fees account has, has a balance of 97,770. But some of those fees have been earned. Well, then what we have to do is recognize the fees that have been earned. That's what we need to do, right? Because that's what we're doing here in part A. We're going to adjust for unearned fees. Adjust the unearned fees. We need to adjust what's been earned. That's what we've earned. That's what we're going to record. That's what the adjusting entry for deferred revenue is, to recognize the revenue that has been earned. So we've got to reduce that liability count. Unearned fees. $39,750. And we recognize the revenue, fees earned. $39,750. Okay. That's part A. But now B's a little different. B, we're now going to move to an accrual. We need to accrue fees. Fees that have been earned but not yet billed. Fees that have been earned but not yet billed. So let me just point out here, because this is two problems in one, and they are two different problems. So in A, we have some fees that have been earned, right? This is what we're doing in A. We are recognizing the fees that have been earned, right? That were initially deferred, but now they've been earned. So that's part A. And then in B, we have fees that have been earned, but not billed yet. This is B, right? So A is fees that we've earned that were initially deferred to an unearned revenue account, right? So the balance in the unearned fees account before adjustment is 97,770. And of these fees, so we're talking about this unearned account, of these fees, 39,750 have been earned. So we've just done A here, right? This is A. We are recording those fees that were initially deferred, but now we've earned them. But then we get to B now, and in B, now we've got some fees that have been earned, but they haven't been billed yet. So we've got an accrued revenue, right? To accrue revenue, we need a receivable and we need the revenue account. So the debit here is to accounts receivable. For 24650. And again, revenue, fees earned. 24650. Okay. So again, A is to adjust the unearned fees that were deferred. Now we're recognizing them. B is to adjust for fees that we haven't billed yet, but we've earned them. So we're going to record them by debiting the receivable and crediting the revenue account. Okay. And then the last one here for this session is depreciation. So in exercise 318, the estimated amount of depreciation, and again, depreciation is the easiest adjusting entry. So all we need to do is debit depreciation expense. in this case for the amount of the depreciation, 66,290. And credit accumulated depreciation, that contra asset account, for 66,290. And that's the entry to recognize, and I'm sorry, this is not the last one. It is the next to the last one. We've recognized the journal entry for the depreciation. And then the last one, depreciation again. And in this one, we are going to recognize the depreciation, journalize the adjusting entry for depreciation. So again, we need to debit the depreciation expense for the 13,900. And we need to credit the accumulated depreciation for the 13,900. And now we have recognized the depreciation, the expense, as well as the adjustment to that contra asset account that we call accumulated depreciation. And that is exercise 3-25, part A. Okay, and that is it. That is hopefully enough to give you what you need to complete the application assignment and the quiz for chapter 3. That's it. Don't hesitate to reach out should you have questions.